Welcome to Dr. Fred Markets. This is not financial advice. Every day, the world of finance, crypto, and artificial intelligence moves fast, really fast, and staying informed is the only way to stay ahead. That's exactly what we do here, together. Let's get into today's video.
Bitcoin just replaced your S&P, and you slept through it. Not in price, in how both now lie to you. Here's the verdict. US stocks and Bitcoin now run on the same rigged oxygen supply, and retail keeps misreading both. Signal 1. Look at today's tape. S&P 500 at 4,739-ish, down about 0.25%. Nvidia off almost 2%. Google up a hair after Google I.O. pumped the AI circus again. On the surface, that screams tiny tech wobble, nothing burger day. But under the hood, market depth is a joke. Order books are thin, liquidity is shallow, and a handful of mega-cap names still steer the whole index. Your diversified S&P exposure is a polite lie. You're leveraged to a tiny AI-heavy Clique that instantly yanks the index around. Signal 2. Now look at Bitcoin at 77,179, down 0.6%. Everyone calls this volatile casino, but compare behavior. Bitcoin just shrugged off one of the most crowded macro fear cocktails you can mix. A rare Ebola strain spreading with no vaccine. Media freaking out about global health threats. Political lawsuits over January 6th sucking the oxygen out of the news cycle. In 2014, an Ebola headline nuked risk assets intraday. In 2020, pandemic fear sent everything into a synchronized panic. Today, Bitcoin barely twitches. The chaos asset is trading like a bored blue chip, while your safe US equity index flinches more on AI keynote slides than on actual biohazard headlines. Signal 3. Follow the liquidity. US stock flows today are dominated by forced buyers. Passive 401k flows that dump fresh cash into the S&P every paycheck, no questions asked. Target date funds rolling money into cap-weighted indices by ritual. Corporate buybacks juicing EPS optics instead of real growth. Most of that flow doesn't care about reality, it just obeys a glide path. Bitcoin's flow is almost the opposite. Spot ETFs funneling in discretionary allocations from RIA committees that actually debate the position. On-chain whales and long-term holders that tap out supply whenever tourists panic. The people in Bitcoin are weird, loud, and often dumb, but structurally, the flow is more choose to be here than autopilot. Here's the cliffhanger. The asset your advisor calls high risk is quietly becoming less reflexive than the one you blindly own in your retirement account. Now, the connection no one wants to say out loud. US stocks, especially the S&P, are turning into a social program. Bitcoin is turning into a market. The S&P's price is increasingly the output of policy and habit. Fed and Treasury flood the system. Yields get crushed. Everyone herds into the same benchmark. Regulations and career risk-force portfolio managers to hug the index. Retail is auto-enrolled into 401ks that shovel into the same product every 2 weeks, rain or shine.
Let's pause for a second. Ask yourself this. Do you really understand what's happening in the markets right now? Do you know how this affects your money, your savings, your future? Most people don't, and that's exactly why you're here. Let's keep going.
Result: S&P's price discovery is basically a popularity contest stabilized by a fire hose of dumb, forced money. Bitcoin, in contrast, runs on voluntary pain. No central bank backstop, no mandated flows, no corporate treasury department smoothing the chart with annual buyback announcements. Every drawdown ejects weak hands. Every regime shift reshapes who's left. So when you compare Bitcoin down 0.36% and S&P down 0.26% today, you're not looking at two numbers. You're looking at two different civilizations managing risk. Here's the one concrete thing you probably didn't know. The S&P 500's risk now comes more from concentration and forced flows than from fundamentals. If you're overexposed to the US index, your real tail risk isn't recession, it's the moment autopilot money slows. Meanwhile, Bitcoin's tail risk is cleaner. Protocol risk, regulatory hits, and dumb leverage. One is system fragility disguised as stability. The other is naked volatility gradually hardening into a macro asset. Mechanism time. Every paycheck, billions of dollars slam into S&P index products no matter what the price is. That props valuations and compresses volatility until those flows slow. That same structural bid does not exist in Bitcoin. Dips still happen, but there's no mandatory flood of pensions catching the knife. paradox. The index looks safer day to day, but its price relies on behavior staying the same forever. Bitcoin looks scarier day to day, but its price relies on a smaller set of explicit assumptions: fixed supply, functioning network, continued demand. So what do you do with this? This is not financial advice, but here is the truth. Treating the S&P as risk-free and Bitcoin as lottery ticket is backward. Concrete action: run a brutally honest flow test on your own portfolio. Ask 3 questions for every major holding. 1. Who is forced to buy this, no matter what? 2. Who is forced to hold this, even if it's stupid? 3. Who can nuke this position instantly without anyone's permission? You want less of your net worth in assets where questions 1 and 2 are everyone, and question 3 is no one with real size. You want more of your bet in assets where price is set by actual disagreement, not HR default settings. That doesn't mean go all in Bitcoin. It means stop worshiping the S&P like a savings account and start treating it like what it now is: a levered bet on policy, passive flows, and tech concentration. Summary: Bitcoin and US stocks now move on different types of lies: volatility versus hidden fragility. Today's tiny moves hide a bigger truth. Your safe index is the most flow-dependent asset you own. Your job is not to predict headlines. Your job is to map who is forced to buy what and ride with the people who actually chose their risk. If you learned one thing today, subscribe and come back tomorrow, because I'll keep telling you the truths your fund manager won't. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's it for today on Dr. Fred Markets. I hope this gave you clarity and a new perspective. Remember, this is not financial advice. Always do your own research. If you found this useful, subscribe. It's free and it helps the channel grow. Find me on the blog at drfredmarkets.com and join the newsletter via the link in bio. I'm Dr. Fred Markets. See you in the next one.